Hello, everyone. Welcome to YGT Talk number 8. Our topic for today is ESG, what we can learn from Europe. My name is Bing Ouyang, your host today, and I'm also founder of YGT and associate director at Asia Society. Let me give you a little bit about the YGT, Young Green Tech. YGT is a project launched by Asia Society with other 5 global partners. We select young green entrepreneurs globally every year and empower them to tackle climate and environmental challenges in innovative ways. So now we have hundreds of YGT entrepreneurs across 40 countries. If you are a young entrepreneur working on big issues, you can apply for YGT 2021 right now. It's totally free program, and I guarantee you can benefit a lot from it. You can just simply scan the QR code on the screen right now. It's very easy to get access. So let me move to our event for today. As you may know, America, China, and Europe in the recent couple of years all come up with their very ambitious plans on ESG, carbon neutral, Green Deal, and so on. So what does that mean to us? Will it be something serious? Will it be something power enough to reshape our business, society, and the planet? Or just another bubble? In our previous episode, we had a guest from Asia and America. So today, let's talk about Europe. We will have 3 parts for today. So first, we will have our keynote speaker to give us a presentation, and then we will have a roundtable discussion followed by Q&A. So welcome to leave your questions during the event on Facebook, YouTube, or Bilibili. So before I introduce our guests, I would again recommend you to scan the QR code on our screen and to learn more about YGT. And we are calling for application right now. Okay, so let me introduce our guests. So first, let me introduce our keynote speaker today, Mirjam Staub-Bisang. Mirjam is head of BlackRock Switzerland and a member of the EMEA Executive Committee and a senior advisor to BlackRock Sustainable Investing. So actually, as I read the news today on Financial Times, the assets under BlackRock's management just reached to $9 trillion. But meanwhile, it has over 150 ESG funds under BlackRock's. And plus, Mirjam was chair of endowment committee of the university instead. So she will give us presentation for today. So Mirjam, would you want to just say hello to our audience?
Yes. Hi, everybody. This is very exciting. Can you hear me well? This is very exciting, and thank you very much for the invitation. Now that I understand this is being screened really, really widely, I get all nervous, but I'm very excited to be here and hopefully share a few insights, answer any questions there may be with also my fellow colleagues today on the panel. I think it's going to be great and super interesting.
Great, thank you, Mirjam. Welcome. Okay, we are also honored to have 2 gentlemen join us today. Our panelist, Alex Wang, Vice President of Global Procurement and Supply Chain of Orange Group, formerly France Telecom, the world's 10th largest mobile network operator and the CEO of Orange Sourcing Consulting. Alex, welcome.
Welcome, and I'm very happy to be here. I'm sure that we are going to spend and share a wonderful moment to discuss this topic, a very important topic for us, for Europe, for China, and for US. And I'm sure that at the end of this meeting, I will become younger as you.
Thank you so much. Okay, let me introduce our 2 young entrepreneurs, our panelist, Robert Heinecke, founder and the CEO of Breeze Technologies. Robert is also our YGT winner of 2019. And the Breeze Technologies has been recognized as one of the most promising European startups by European Parliament and the European Commission. Robert, long time no see. Welcome.
Long time no see. Thank you for having me. It's great to be here, and it's a great panel. Thank you for having me.
Okay, great, ladies and gentlemen. So let's start. So first of all, let's welcome Mirjam give us a presentation. So Mirjam, the stage is yours.
Thank you. Let's get started. I'm going to give you an investor's perspective on sustainability. The focus will be not specifically Europe. I will. There will be European aspects of it, but as BlackRock, as representative of BlackRock, the world's largest asset manager, we always try to take a global perspective in everything we do. But here's something actually for our German participants, and I am sure actually you, Robert, would you know who this gentleman is?
I'm not sure, to be honest, no, but he looks very German.
Schopenhauer?
He looks very German.
No?
Schopenhauer, exactly. Schopenhauer. It's Arthur Schopenhauer, this the famous philosopher of the 19th century. He said something very meaningful when we speak about sustainability. All truth passes through three stages. First, it's ridiculed. Second, it is violently opposed. And third, it is accepted as being self-evident. I've been active in the space of sustainability for over 10 years now. And I can tell you, 10 years ago, this was an entirely different landscape. You had a few tree huggers really interested in sustainable investing, a bit of microfinance here and there. But other than that, certainly big finance was not interested in sustainability or sustainable investing. Then passed a few years where we in the industry faced a lot of criticism. People say, wow, performance is not good. We can't compromise on performance for sustainability. But then eventually, and I think this really happened over the last few years, sustainability and sustainable investing became self-evident. You know, what really brought about the change? Yes, I think there was a change in society, but very much also a change in regulation. I'll come to that, the change in regulation in Europe, which brought sustainability and sustainability in the spotlight of investors globally and forced industry participants to change in a very, very short time. Let's touch on market development. What you see here is the growth of sustainable investing over the past couple of years. And, you know, that looks big, 2 trillion in global assets under management. Still a small number compared to the world's managed assets of 80 billion, and this only represents funds, so it doesn't comprise mandates. It's the total number is a bit bigger. But I think what's important here is to show you the trajectory and how much actually sustainable investments have grown over the last 2 to 3 years. And perhaps this slide actually outlines it even better. You have the red bars, which show you the average industry growth of the asset management industry, you know, hovering around 3%, 4%, 5% per year. And then you see the yellow bars, which represent the growth of sustainable investment strategies comparably. And what you can see here, this tremendous boost that sustainable investments have over the last 2 to 3 years, over 5 times higher growth, almost 30% growth in sustainable strategies only last year. So this has been just a really, really, amazing journey. But we feel at BlackRock, we feel that this is just the beginning. It's the beginning of a very, very big tectonic shift from, say, a traditional investment approach to a sustainable investment approach, which integrates sustainability criteria in the investment process obviously there are different approaches, be that ESG integration strategies, certain best-in-class strategies, thematic investments across asset classes. So there's lots of different approaches, but what you can see here, the momentum is very, very strong. And actually, this is probably one of my favorite slides to show this very strong momentum. Last year, we conducted a study among some of our clients. 425 clients participated in the global study, representing 25 trillion in assets under management. 25 trillion in assets under management, if you recall, that's about 30% of globally managed assets. And we asked them to what extent their assets are invested with a sustainable investment approach today, and they come up with numbers between 13 and 20, 12 and 20%. So, you know, but yeah, not huge yet, with quite some potential. But we also asked them, where do you expect to be in 5 years' time? How do you plan to change your allocation to sustainable investment strategies? And what you see here now is that across the board globally, we expect a doubling of sustainable investment strategies, going from 18% currently to 37% overall. So that is huge and shows you that the momentum that we saw picking up over the last 2 years is actually expected to be quite sustainable. And again, it's a tectonic shift, and I think it's a tectonic shift that we have to keep in mind, this reallocation of assets from non-sustainable to sustainable, which in fact will have an effect on valuation and asset prices globally. Now, what has led to this boost over the last couple of years? And here, this slide with all these acronyms actually depicts a number of regulations we see in the EU, in Europe, but also some global regulation, and it represents the big boost that we also saw in regulation over the last couple of years. So in the last 5 years, actually, ESG capital market policies and regulations, they have nearly doubled globally since 2015. And today, we count over 800 regulations related to sustainable investing, sustainability in capital markets, and almost half of them in Europe. So what you can see here, this regulatory shift, this regulatory push that we see in Europe really had its effect. And when we speak about the regulatory push in Europe, it really started 3 years ago with the European Sustainable Finance Action Plan of the European Commission, which I would see as a very, very important driver for sustainable investments in Europe, but also with a global effect. Why? In Europe, we could say about a third of the world's total assets are managed in Europe by European pension funds, insurance companies, but also private individuals. And that money now, due to this European Finance Action Plan, is being managed differently. What are the main objectives of the EU Sustainable Finance Action Plan? First, the first goal is to reorient capital towards sustainable investments. The second goal is to integrate sustainability risks like climate change into risk management processes of investment managers, asset managers, and wealth managers. And third, to increase transparency and long-termism of investors. And when we think about this ESG integration in risk management processes, it's really for institutional investors to disclose how they integrate ESG factors in their risk processes, but it's also for wealth managers and asset managers anybody who's marketing financial products, that they need to understand what the sustainability preferences are of their clients, and they need to match it with investment products that match those preferences, and then actually report on them. And we believe, and we actually see it happening now day by day, that with this initiative and this regulation, of course, this transparency that is now being provided, that a lot of capital is shifting from non-sustainable to sustainable, because all these investment products are actually being created and investors are being offered a choice. So, for example, any pension fund today needs to show in their reporting to what extent their assets are managed with a sustainable investing approach, and to what extent its investments actually contribute to the climate goals of the European Union. So I think that's a really, really important push. But when we think about regulation, and I always like to say that regulation isn't just something which falls from the sky one day, but regulation is actually much more a reflection of what is happening in society and how the values are changing in society. And so, things take a bit longer. As I said, 10 years ago, sustainable investing was a niche for some tree huggers, aficionados. And but I think with changing values in society, be that from natural catastrophes or just how obvious climate change started to be, or social challenges became so evident, that actually spurred this change in values and preferences, and found its place in regulation. And when we think about changing preferences, I always like to refer to that study of a couple of years ago, which was done by Barclays Bank among their private clients. And they asked people whether they've ever invested in an impact investment. And not really surprisingly, 43% of the under 40-year-olds, the millennials, probably everybody here on the call, had done an impact investment, an investment which actually didn't just provide a financial return, but also had an impact, a social or an environmental impact, which is measurable. And which is being reported. So 43% of the under 40-year-olds, and then at the other end, only 3% of the over 60-year-olds. So that would be the parents of the millennials, the baby boomers. Now, you could say, why does that matter? How can it matter? Because the under 40-year-olds, they don't really have money, and when they think of impact investing, they probably think of a few $100s in a crowdfunding exercise. That's not serious money. But, you could be wrong, because when we think about the millennials today, we should think about all these young people which will inherit money from their parents. And what we speak of in the finance industry is the biggest wealth transfer in history. Over 24 trillion US dollars in the United States alone are expected to be passed from the baby boomer parents to their millennial children within the next couple of decades. So this is huge. This is a huge wealth transfer. Again, referring to the 80 billion I cited at the beginning, this is about a third of these assets are going to be transferred and are going to come in the hands of the millennials. And, everybody, people here on the call who are millennials themselves, they probably know best, but millennials are very different from previous generation. They consume differently. All this veganism and what have you is just an example of that. But they also want to work for different employers. They want to work for employers which has a purpose, for an employer which has a purpose which aligns with their own values, with their own purpose in life. They don't want to just work for money. They also want to see purpose in the things they do. And eventually, that shows how they will invest, how they do invest today, maybe in a crowdfunding in a startup, but that will be reflected in the way they will invest their money in the future. So the financial services industry is really getting ready for that. On the one hand, providing these investment products. I mean, we have regulation on the one hand, but we also have just clients who demand different products. And then it's also about corporate issues, corporations, companies that want to be viewed favorably by investors and get up to the challenge of being more sustainable. Now, let's think about the challenges. Performance. Performance was always kind of the tricky aspect in sustainable investing, because there have been, a number of myths spread on sustainable investing, sustainable investments outperforming traditional investments. Well, last year was really the moment where that view has changed, and it became evident to people that during the sell-off in the COVID crisis, sustainable investments actually dramatically outperformed their traditional counterparts. And here we looked at a set of representative indices, best-in-class sustainable indices versus their traditional counterpart, and found during the COVID-19 crisis, that's the red donut, that 94 of these indices actually outperformed their traditional counterparts. When we look at the full year, that's the yellow donut, it's still 81% of these indices still outperformed their traditional counterparts. Looking back, we see that both during the Fed policy reaction, which led to a market sell-off in the fourth quarter of 2018, sustainable indices outperformed, and the same applies for the crisis during the emerging market downturn in 2015 and 2016. Now you could say, well, it's due to weaker energy prices and the sell-off of oil and gas stocks, and that indeed played a part, because traditionally sustainable indices would be underexposed in energy, fossil fuels, and overexposed to technology. So I think those both aspects definitely helped last year. But when we look at the outperformance, which is depending on the market you look at about 2% last year, then about half of that outperformance is due to lower exposure to oil and gas or a higher exposure to technology. But about 1%, so over 50% of the outperformance can be attributed to sustainability factor. So this reinforces the belief that sustainable companies are more resilient in market downturns. Let's look at another challenge. And here I go back to our study, which we conducted last year on the sustainable investing behaviors of our clients. And we asked them, what is the biggest challenge for you not to adopt more sustainable investing approaches? And it was very clear, the outcome was very clear. It has to do with the poor quality or availability of ESG data and analytics. And that makes sense when you think about it. I mean, if you're asking investors to rely their investment decisions on ESG data, which is not great, you would say, well, of course, that has an impact. It's almost like providing an analyst with a financial report of a company, or two financial reports of a company, one which maybe shows this company has a positive cash flow, and the other one shows that it has a negative cash flow. And I think it's actually this picture, and I don't know if you can read the title, but it's actually this picture, this graph, which depicts us very well. It's the ESG ratings of different companies. Once looked at through the lens, the ESG rating lens of the MSCI, and once looked at through the ESG rating lens of FTSE. And so what you can see is very, very little correlation. And frankly, you could basically take any two ratings agencies and the resulting data currently, and the correlation would be somewhat challenging. This has to do with the different approaches of ESG rating agencies. On the one hand, some are backward-looking, some are forward-looking, some do interviews with companies, and some rely on publicly available data sources. So some are values-oriented, some are value-oriented. Now, ESG data are a major concern for investors, and there are good news though. When we look at the ESG reporting of companies in the S&P 500 back in 2011 or today in 2019, we see a stark difference. 20%, it was in 2011, only 20%, 1 in 5. Today, it is 1 in 10 companies provide a sustainability reporting. And again, the good news is that the different data reporting agencies, reporting frameworks are starting to align. They all, like industry participants, are really looking at data, hoping to make it much more comparable and much more useful for investors. Now let's spend a few minutes on BlackRock's approach and commitments. Who knows this guy? Anybody? Robert again, you were pretty good before. No, it was Alex actually who knew Schopenhauer. Maybe Alex knows this guy. No, Ben? Robert?
I think that's your
boss,
right?
That's my boss. That's my boss. Very, very well said. So this is Larry Fink, who came up with this statement, climate risk is investment risk, in his letter to CEOs early last year in January, when our sustainable investment strategy and approach was communicated to the broader industry to make sure the CEOs of companies really understand how we think about sustainability and how we think about climate risk and what we want them to do for the benefit of our clients. Because whatever we do as the world's largest asset manager is that we act as a fiduciary to our clients. We want to make sure that when we manage portfolios for clients, that we manage them as good as we can, and that in addition to obvious financial risks, we also look at risks which may not be clearly stated in an annual report of a company, but rather sustainability risks which are perhaps not reported, and so we rely on different sources to find out about those risks. So climate risk is investment risk, and as a result of that, we believe that sustainability should be our new standard of investing. Again, a statement of our letter to CEOs last year. Now, this investment conviction is based on two theses, and I alluded to it in the beginning. First thesis, asset prices and portfolio risks do not fully reflect sustainability-related factors today. So think about climate risk. Climate risk is about physical climate risks, like storms, flood, drought, what they can do to physical assets, let's say buildings, for example. But also it's about transition risks. And transition risks are risks that companies are exposed to that have to do with regulation. So regulation is changing and a company is not properly prepared for that. Some of its products might become obsolete, or say an energy company has all these fossil fuel assets on the balance sheet, which it might not be able to sell in the future anymore, so-called stranded assets. And then secondly, market factors will accelerate the reallocation of capital towards issuers and assets with positive sustainability characteristics, in turn impacting valuation. So this has to do with the disclosure of risk. The more market participants will understand what risks they hold, the more they will reallocate their capital to less risky companies, the more these companies will then eventually appreciate in value and asset prices, which in turn will draw even more capital towards sustainable assets. So what we did last year is we focused on building sustainable portfolios. So we made sure that all our active investment portfolios were fully ESG integrated. So every strategy had a very specific approach how to integrate these sustainability risks in the investment process. We also excluded, for example, thermal coal in all our active investment portfolios because we felt that was just too big a risk to hold for our clients. And then secondly, we also increased access to sustainable investing and increased our offering in sustainable ETFs, doubled our offering in sustainable ETFs, and launched many funds, active funds that clients could invest in, which had a sustainable investment approach. And then thirdly, we moved sustainability to the center of all our stewardship activities. Stewardship is about having an active dialogue as an investor with companies and about voting at general assemblies, supporting shareholder proposals, and so on. So we wanted that companies actually were transparent about climate risks in their portfolios, and it also showed us a reasonable plan to what extent they can mitigate those risks or adapt their strategy to be successful also in a low carbon economy scenario. We put 200 companies on a watch list that we felt were not compliant or not transparent enough, and told them, well, you better get your act together and make sure that you can present such a persuading plan by the next General Assembly. If not, we must take measures, and these measures, they go as far as not re-electing certain board members or supporting shareholder proposals for more transparency on sustainability matters at General Assemblies. And perhaps to give an example on the latter, for example, we did not, we supported a shareholder proposal where a company said, well, we commit to a net zero pathway for 2050, but didn't really show how they were going to get there. And we said, no, the shareholder proposal said, this is not enough. We want to see from the current management what the current management is going to do, say over the next 5 years, how they're going to change their business model to actually successfully get on this net zero pathway. And eventually the company has changed, and from this 30-year out commitment was changed into a yearly reporting on their sustainability approach and how they're meeting their goals. Now, when we look at our 2021 commitments, here we commit to a net zero world. I'm not sure if you can read the title, so I'm reading it out. Because we feel climate change is one of humanity's greatest existential threats. And in that sense, 2020 was a historic year in climate action, with more and more companies and governments making pledges to commit to a net zero world and to uphold the tenets of the Paris Agreement signed in 2015. So for us, achieving a net zero economy means drastically reducing emissions by 2015 with the goal of limiting temperature increases to 1.5 degrees above pre-industrial levels. And again, from our belief of climate risk being investment risk, we feel we must push companies to really embark on a net zero path on the one hand, but we also want to provide investment opportunities for our clients that they can benefit from investment opportunities that present themselves in this transition period of over the next decade. So first and foremost, we have already committed to providing proper data. We're now really focusing very hard to finding, say, a temperature alignment metric. So eventually, companies can say, oh, my portfolio is on a 4-degree path. How do I need to change my investments to go to a 2-degree path or a 1.5-degree path to arrive to support a net zero world in 2050? So data is key. Then investments, I highlighted it. We really want to provide investment solutions where clients can benefit from these investment opportunities in the transition. In that context, I might want to highlight, we just published our joint venture with Temasek in that area, where we're jointly seeding a large investment fund for innovative technologies to provide solutions for climate change infrastructure and technology. And then thirdly, stewardship. I mentioned it already. A priority of last year is becoming an even bigger priority related to climate change this year. So we're really expecting companies to be very, very clear and transparent about their net zero pathway. This is what we expect of companies today. And this year we're engaging with 1,000 companies, which represent 80% of the carbon emissions globally. So I think we're coming to an end. Let me just, this is just an overview slide on sustainable investing at BlackRock. We focus on 3 areas. It's sustainable investing, which I highlighted, sustainable investment solutions, but we also perform the research and reporting. Secondly, it's about investment stewardship, the engagement of BlackRock as a shareholder with companies, and our push we make there. And then thirdly, it's about corporate sustainability and just making sure our operations are carbon neutral. So here, this is my final question to you, to everybody on this call. Should sustainability be your new standard? Ben, over to you.
Mirjam, it's an amazing presentation. It's given me a kind of a feeling like an amazing class, because you come with a lot of data and a solid content and a cold call. Say, hey, do you know this guy? Thank you so much. I specifically very impressive about one of the slides about the generational change, the millennials. You argue how this. So that's
that's our hope.
Yeah, and opportunity actually. When we found the YGT, we argued, say, this younger generation gonna show very differently. Man side a lot of things. So you're gonna, when you talk about ESG or CSR or SDG, actually all of these terms, concepts also arm at future, right? Okay. So let's start our roundtable discussion. Mirjam, thank you again. That's a very solid. But I come up with one question. I still remember you show us in your presentation, say ESG related fund. They they can outperform other traditional funds. So based on my very naive understanding and experience, when we talk about ESG, it comes with a lot of regulation, and normally the players, they bear more like a cost where a lot of limits. Why they can outperform, right? What's the reason they can outperform? You show us the result, but I want to know the reason.
Yeah, and I think here it's interesting, and it's an interesting question, but it's interesting to kind of look back in time when you think about. I think it was what was the index called? One of these very, very early sustainable indices, which was a best-in-class index, only investing in the 10% most sustainable companies already 20 years ago. That index actually consistently underperformed. And people were wondering, or no, people weren't wondering why it underperformed, it just did. And now with the knowledge we have today, it's obvious that this index underperformed for two reasons, actually. A, data quality was so bad. Remember the data I showed you, 2011, only 20% of companies actually provided sustainability data. Well, naturally, you would have an investment universe with only 20% of companies providing this ESG data, and that led to a negative selection, or not, well, led to a selection where your investment universe shrank to 20% of companies which provide data, and of these, you take the best ones, leaving out 80% of companies. And that was in 2011. I don't know what the landscape was in 2005, but you probably only had about 10% of companies providing sustainability data. So I think the market wasn't ready for that at all. When we compare today, we have much, much more robust data. And so it is, as a selection criterion, ESG data is much more robust. It's not perfect yet, but it's getting much, much, much better, because we know that traditional investment theory says, and I personally believe in that as well, if you limit the investment universe dramatically, you can't achieve the same returns as with a bigger investment universe. So I think today we're just in a very, very different space.
Yeah, okay, let's move to Robert, because I think Robert can provide us a very unique perspective under this question. So Robert, you can also clearly tell from the Mirjam's presentation, now the ESG become very fashion, right? Does this change make your business easier? You can make more money now?
What a great question to ask. Do I make more money now? Well, actually, I mean, there's a lot of different, I think, current trends that are really influencing on how the startup community is performing, and also how sustainability startups are hopefully nowadays outperforming their peers. And I distinctly remember I founded Breeze Technologies in 2015, right? And back then, that was 6 years ago, longer than 6 years ago. And back then, sustainability wasn't such a big topic yet. And at the beginning of our journey at Breeze, we actually tried to raise outside venture funding. And we had a really hard time in doing that, because everybody was telling us, nobody cares about air quality, nobody cares about measuring pollution. And then a couple of years later, Dieselgate happened, Volkswagen was in the news around the world, and suddenly air quality was a hot topic everywhere. And just yesterday, I saw the news last week, the White House has committed $100 million just for air quality monitoring throughout the United States. And that shows the huge growth segments that we are suddenly in, from a next to nothing industry a couple of years ago to this huge opportunity that we're currently having. And of course, I mean, we are addressing the public sector with our solutions. We are also working with large corporates, and you sometimes fight against some resistance internally, right? The mindset hasn't arrived everywhere yet in these organizations. So that includes both digitalization and that includes also sustainability. And the only thing that prevents us from, let's say, making more money nowadays is really just the generational topic, I think, mostly. Once the decision makers in the large corporates, the middle management, once the decision makers in the public administration actually get replaced with the next organization, I think everybody in the sustainability startup community will have a really great time in doing business there. And it will be the other way around. Those startups, those ventures that are not committed to sustainability and that don't have sustainability at the core of their business, they will be the ones that are going to have a harder time in the future.
Yeah, okay, great. I want to move to Alex to hear another angle from our spectrum. So Alex, you work for Orange, a huge company. As we all know, there are many big companies that are working on CSR, but some quite serious, some not actually. So based on your experience,
yeah.
So for big company, what's the key elements to have a serious CSR engagement? Is that kind of like, say, more capable employee working on this, or they have a genuine pursuit for the public good? Well, how can we guarantee a big company is serious on this kind of issues?
Yeah, for Orange, yeah, you know that Orange is green. Yeah. It's a color we love very much. Well, Orange is pay lots of intentions for the CSR development. The logic of CSR is embedded in all our business and in every activity of our company in terms of IT and the green network, in terms of CO2 reduction. You know that we are committed to reach the net zero in 2040. And also in terms of supplier management, to manage our relationship with the suppliers, and also taking care and support startups, not only in Europe, but also in Africa and the Middle East, in Asia as well. And we also start to link the performance of our people to the performance of CSR. For instance, for the long-term incentive plan for executive manager, 20% of their bonus are based on no extra financial criteria. It's for real. It's Russian. And also for ex-committee member, the highest level of the management, 33% of their bonus are based on social criteria. So it's really very, very serious. And when we issue RFP, request for proposal for our suppliers to have products, we have 3 types of notes now, evaluation. Before we have technical notes, commercial notes, and now we have 3rd family of notes. The evaluation is CSR notes. So we have embedded this logic into the selection process. And also in our specification, we precise for certain products that we ask everybody, every supplier to use a certain percentage of recycled plastics, for instance. And if you couldn't meet these requirements, you couldn't participate in the competition. So, and I like to share another example, not just for Orange, to show that the sector of telecom is progressing, is pushing the development of CSR. As you know, the telecom is the backbone of all other activities. So it's a very interesting story. In 2009, we have created alliance for CSR. That means it's a cooperation between operators. That means it's cooperation between competitors. We are competitors, but we come together. We were convinced of three things. Firstly, it's a global challenge. It's not my challenge, your challenge, and it's a global challenge. And secondly, we couldn't fix this challenge alone. Absolutely, we couldn't fix it alone. And thirdly, we can start this type of cooperation with something concrete, tangible, if we want to have a chance to convince the cooperation and also the people. So we have created we call it joint audit cooperation. We've chosen something very concrete, the CSR on-site audit of our common suppliers. We share the cost, information, we push together the collective action plan to the improvement, and we worked out a common checklist, including 4 domains: social, health and safety, environment protection, and business ethics. So together we push this implementation. We were 3 at the beginning in 2009. At that moment, there were lots of doubts. They thought, wow, you are dreaming. It couldn't work. And now we are 17 with a big name as AT&T, Verizon, Telefonica, Vodafone, Deutsche Telekom, and Orange, and so on. We represent 3 billion end users in the world and represents half of the telecom revenue in the world. So together we share the best practices between us, and we encourage our suppliers to follow our approach. For instance, in terms of CO2 emission, we are pushing all telecom suppliers to follow us, to commit the net zero.
I think that's an amazing story. Say,
yeah, it's competitor together. Yeah. We're still competitor. We are in a fierce competition, but there is something beyond the competition, something a common cause.
Right.
We need to give our hands and to work together.
Yeah, to educate people to look somehow beyond and look some big picture.
I think it's beyond cooperation. It's a new way of thinking. It's a new way of living. We need to adopt this new philosophies, let's say.
Yeah, great. But I want to not just cover the rosy side of ESG or CSR. Let's go to look at some like a downside of this. This question to all my panelists say, do you think ESG or CSR is a game for rich countries or rich people, rich big companies? Because the argument is like this: for a lot of poor countries or poor people, they cannot afford the higher price of like plastic-free products or cut off their revenue generating coal mining. You cannot require them to do this. And when I searched the news, I found it's not just for poor countries. Like even in France, there are like protests against the rise of the fuel tax. And in America and Germany, there are a lot of protests, and some populists they use this. Say, hey, even our previous president of America, they argue, say the global warming is fake. So how do you feel this? Only what we can say is now is only big countries or big companies like BlackRock, they argue this. But how we can promote this kind of things to, or is not fit for another side of the spectrum people or players? How do you feel, both of you?
Well, I'm happy to have a quick go, because actually this morning I was faced with exactly that question at a panel discussion for the new carbon emission regulation that we're about to vote on in Switzerland. And we have on the one hand a representative of the Populist Party who said, well, all these, like this regulation is going to come at an extra cost to people. And on the other hand, you had the supporters of the regulation who said, well, we have to do it. We have to take measures. If not, we are not going to be able to turn around climate change and take the respective measures. And frankly, I was just there as a representative of the finance industry. But I asked myself, yes, of course, it comes at a cost today. But that cost is so much smaller compared to the cost we will face when we cannot stop climate change. I mean, think of glaciers melting, think of rising sea levels, think of the physical damage climate change will have on assets. Poor countries are going to suffer the most from that. And for this, there is a lot of capital around to support the greening of the economy, also in emerging economies, and more capital will be made available for that. But I think we have no choice. We truly have no choice. We can maybe at the short term save money, but it's going to cost us so much more in the future. And I think as decision makers today, but also I have 3 children. As a parent today, I really think we cannot do that to our children.
Yeah. May I? Yeah. I think we should change the angle when we analyze this cost or not. Apparently it's a lot of cost, but at the end of the day, it's about investment. It's investment in our future and investment in the future of our children. That's the first point. And second one, we think that take care of small companies, small suppliers. It's also part of CSR of a big company, big group. For instance, in telecom, we have lots of subcontractors. They are small company in China and in other countries of Asia. And in our cooperation, we have set up academy to help them, to train them to handle these matters in their factories, and also help them to train and manage the supply, their supply chain, even smaller company in their supply chain. I think it's not a isolated problem. We need to look at the possibility to cooperate horizontally and also vertically.
One thing that I would like to add from the startup perspective. Sorry,
sorry, Robert. Because both Mirjam and Alex mentioned next generation. I'm sure you don't have kids yet, so you also want to invest in. You think that's fair for you to invest on next generation now, or I'll just let them do that?
No, I think that's perfectly the way to go. And I mean, we have, I think, as a society, we have a responsibility to following generations, whether we personally have children or not, right? Even people who decide they're not going to have children, they're still part of the human race, if you want to call it that, and they have a certain responsibility to that, I feel. But even to what you said, Ben, I mean, being more sustainable doesn't necessarily need to mean that even today it's going to be more expensive or it's going to incur some additional cost, right? I mean, I know a lot of entrepreneurs, and I mentioned that 5-6 years ago, the sustainability sector in the startup area still completely looked different. So we had to face these challenges and exactly this argument it might be more sustainable, but it's also going to be more expensive. We had to face this for the last 5 to 6 years. And there is amazing startup talent out there that came up with incredible solutions where a fridge, for instance, for Africa is not only more sustainable because it's solar powered, but it's also actually cheaper than what we sell here in the markets in Europe as fridges. So people in Europe actually start adopting technologies that have been developed as low-cost sustainable solutions for emerging markets. And that's really, really incredible in my opinion. And then also looking at what we do. So we are actually now also looking at sub-Saharan Africa as a market opportunity for us, because we turned large $1 million air quality monitoring equipment into $1,000 pieces. And that suddenly makes it attractive also for environmental agencies down there that can start creating data baselines that can then help them to get funding from the World Bank for the sustainability projects they want to do. So I think the whole startup sustainability angle and saying, oh, it's going to be more expensive is a little bit short on thought, because there are great solutions out there that even cost less money, because this is what we have to deal with, and are still so much more sustainable than the status quo that is being used today in the mainstream.
Yeah, I think Robert, I totally agree. You may remember Dr. Water, our YGT of your year. he doing the solar powered clean water equipment in Africa and make the clean water even cheaper. And Alex must be very familiar with her. She's doing the solar life for Africa people.
We use the solar energy to power a base station for our 4G and shortly for 5G in Africa as well. Yeah, and solar kit for home, as well for the family use and for children. For them could read the book in the evening and in the night.
Right. Okay. Let's touch on another part of this topic. So we have also heard some like a serum of this ESG thing, greenwashing, like Mirjam's former colleague at BlackRock, the former CIO of sustainable investing at BlackRock, the Mr. Fancy argued, say financial world is now greenwashing ESG, making it more like a PR. So how should we look at this? Like Robert also, I still remember in 2019 when we traveled together in New York, you wear that SDG badge on your lapel. But now I assume a lot of people they label themselves or branding themselves, say, hey, I'm SDG champion, blah blah. How should we look at this? People are just use this as marketing. Is this good or okay, or some dangers behind we should be aware of that? How do you guys feel?
Well, if I can volunteer an opinion here, I think greenwashing is a huge concern, but the financial services industry, asset managers, wealth managers are very, very concerned that greenwashing is really going to impact that trend towards sustainable investing. And it's been extremely prevalent, that concern for greenwashing over the past few years. And in Europe, though, now we have this so-called SFDR regulation, which forces all asset managers to provide transparency on the ESG qualities of their products. So there's a very standardized approach to make sure products become comparable, that a BlackRock product can be compared to a UBS product and it's categorized the same way. And for the end investor, they can say, okay, I take a sustainable product from BlackRock or for UBS, and it suddenly becomes comparable. And just calling something sustainable is not enough anymore. You have to prove what's in there, what your approach is, how it benefits certain sustainability goals and does no harm. On the other hand, impact has, you can't just call something impact because you feel like it, but there's a certain standardization. Now that is true for, again, the European Union. Also, that regulation was part of the European Union's Sustainable Finance Action Plan, but we expect that to have a big impact on the rest of the world. I mean, BlackRock has now changed, has provided that transparency for their European funds platform, but now the technology, the categorization is there, and it can be rolled out globally, and that applies to other large asset managers. Basically, it's a global industry, and so we're going to see that standardized approach globally. So I think that's an important push against greenwashing in the fund management, asset management world.
Yeah.
Yeah, I think greenwashing is really a huge concern also for sustainable businesses to deal with, right? So, I mean, we get contacted by huge corporates that want to just associate themselves with us to look more sustainable or look more innovative to the outside. And I think it's the responsibility for any sustainable business really to look out for that and to also say, no, we will not do that. And we have turned down deals in the past because we said, no, this is not a brand that we would like to associate ourselves with in that regard, because it doesn't fit to the core thesis of what we are trying to do, which is to enable society to create a healthier environment for everybody. And I just put in the name of a certain oil and gas company and SDG into Google, and I found this page on their main website where they say how they are contributing towards the SDGs and how they are an SDG champion. And they say they have every SDG they are somehow covering. And under that, they have 2 pages of legal disclaimers and saying, of course, these are only ambitions and these are not financial statements that we are giving here, and this doesn't mean anything for our shareholders. And I think this really shows the kind of, the disconnect between, on the one side, trying to show yourself as a sustainability company, but then at your core business, this is not what you are. And this is what we really have to look out for.
Yeah. I think that greenwashing is a phenomenon at the beginning of the move. I think they will pass. And when we come into really the transparency and the exact figure and the tangible results, and also the regular follow-up year on year, this phenomenon will pass.
Yeah. Okay. So great. So, ladies and gentlemen, let's move. The last part of our discussion. I want to move back to our topic today. You're all based in Europe, Switzerland, Germany, France.
Europe and Paris and Beijing.
Okay. Yeah.
I produce CO2, so it's apology.
Okay, but much less during the last year, the pandemic.
Yeah.
Okay, so Mirjam actually gave us a lot of new data, but I also found the data very interesting in your book, Sustainable Investing for Institutional Investors. There's a data for 2011, you argue, say, 5 trillion euros out of 7.7 trillion euros global sustainable investment is from Europe. Europe is way ahead of other big players or markets like China, America. Why? Why European players or funds, corporates, startups, they are so care about this issue? I want to hear more like your personal reflection on this. So why European people there? So go ahead.
I think, thanks that you're referring to my book, which I wrote 10 years ago. And
could you show your book? Could you show your book? Do you have?
I don't have a
I can share. I can share with you later.
Okay. Sorry.
Oh, that would have been great now to hold up a copy, but I don't have one handy. No, but in that book, I also covered aspects, the historical aspects of sustainable investing or sustainability. And I think sustainability in Europe goes back to I think it's the 18th century, but here maybe Robert can help me with German history, when there were these iron ore mining activities in Germany, and for this you need for these smelters. I think you call them smelters. You needed the woods from the woods from the woods around these factories, these mining factories, and the problem was at the time that they produced so much iron ore and they used so much wood that eventually they had no more wood. And so they depleted the source of the wealth of a region because suddenly they couldn't get more iron ore out of the earth because they couldn't make use of it anymore because they didn't have the wood anymore to turn this iron ore into proper iron. And I think that's what you call actually the cradle of sustainable thinking, that you shouldn't use more for your current use that uses up your resources that cannot be replenished. And then eventually you had the United Nations with their first thoughts on sustainability. You had the Club of Rome. You had all these European initiatives on sustainability actually very, very, very early on. So I don't think it's surprising that you see this big push on sustainability and this advancement on sustainability coming from Europe. It's this responsible thinking that probably has a lot to do with the history and the humanitarian thinking that we have here in Europe, in Central Europe.
Yeah, I agree.
I think so.
Yeah.
I would welcome a Chinese perspective here.
Yeah,
some philosophical thoughts.
I think there is something with the tradition of European country and European cultures. For instance, in France, with the Human Rights Declaration and also the French Revolution and the Renaissance movement and so on. I think there is something in DNA of European people somehow. Yeah, a cultural DNA, let's say.
Yeah, the left-wing political philosophy is also very.
Yeah, all those attentions paid to human being.
Yeah.
As human
so now
being.
What we're doing is
not just human resources. Human being.
Yeah. So, but what we're doing now is a DNA transfer to the world.
Yeah.
One of the reasons is also, I think, because we can afford to, right? So we are in a quite comfortable situation, and I mean the EU really different to the US and China is it's just not one country. It's many countries that have different interests, and what kind of unites us though is that we are all somehow affected by climate change, by the long-term environmental impacts of the initiatives of the industries. And because that is such a common denominator for all the countries that are under the umbrella of the EU, I think that's an easy area for us to actually do progress in compared to other topics where we are maybe struggling a bit more than the US and China.
Yeah,
and perhaps with the history of industrialization that we have in Europe, it's much more dense than the US. I mean, I remember, being a young child in the 80s. I remember at the time it was not safe to go swimming in the lake basically in front of my house because it was polluted, because there was already so much industrial activity that it was not safe. So back in the 80s, I think we had that first push for environmental protection and greening the environment and making industrial production cleaner and less resource efficient. So I think it probably has to do with the density of population and the industrial activity being so close to cities and so on. And probably, China was very much in a different place at that time. And I think the US is just much, much, much bigger, and had more natural resources. A small country like Switzerland doesn't have these vast natural resources. So we always had to be very careful in how we use them. And we couldn't just waste them. And that applies to many countries in Europe because there's just there are all these smaller countries and each in itself doesn't have vast resources. Yeah,
and what we see is a huge increase of awareness at the global level concerning 2 points. First one, we have just one planet. There's no planet B. We need to take care of it. And second one, we are all responsible. We are all responsible to help the planet to heal and to protect her. I think this increase of awareness is very, very visible as well in China. I lived for many years in China and will travel very frequently as well for the time being. We can see that since 2010, there is a rapid progress in China of the CSR development and through several axes. The first one is the circular economy, and the CO2 reduction is now a very hot topic. And ESG is very, very, very hot for the time being. And together with the green finance, and I think the comprehensive agreement of investment, there is a chapter about ESG and about CSR. I think it will give an extra push for their development in China.
I can add one more thing on this. I think another reason might be, if you just talk to people, say, okay, we only have one planet, it's good, but why should I? It's too big. You know what I mean? So
true. We are all responsible.
Yeah. So my argument is, maybe somehow you like Mirjam mentioned, you should show people the change, right? Like take China as an example. When I traveled to China in, like say, 6 years ago in Beijing, the air pollution is a really terrible.
Suffocating.
It was like a smoking while I was working. But now it's really changed, right? There are a lot of sunshine, sunny days, and people experience this change, and then they become believer of this. Yes, you say, hey, that's really make my life better. Everyone, I think by nature, our human beings there, we will be much more comfortable living in a clean, environment. So maybe that's also the reason. I think Europe is specifically on maybe people, they go through the industrialized age. They go through this kind of a deep pollution, like what happened in England, right? And now everything's going back, and then they say, okay, now that's good. Okay.
I think just a word. I think the young generation is our hope. They think differently, and they see things differently. They are responsible consumer and responsible when they buy something. They add a extra criteria to pay more to get sustainable product to help those corporates, big or small, to have the responsible growth.
Yeah, totally. So we are, we're already over our time limit, but I still get one Q&A from our audience. There are a lot, but let me pick one that's really relevant to our today's discussion. And I changed it a little bit because our audience is asking about the case in Myanmar, but I think it could be a good question even beyond. Say how can we support a smaller size of enterprises like Robert startups? How the big companies, big investors, how can we encourage, empower the young people, younger generation to work on this, to work on the sustainable SDG issues business? I think that's many questions to Mirjam and Alex, but Robert, welcome to add on. Eileen, this speaking for you. They are speaking for you. Okay.
Yeah. For instance, for small startups, we have created a network of acceleration center for helping those startups. We open our network and IT resources to help them, and also organize lectures and trainings for them. And most important point, to find them, to help them to find clients, to bridge between their solution and the possible business unit inside Orange and outside Orange as well. It's very, very concrete, especially in Africa.
Yeah, I think the last point is really the most important one. So, I mean, there's a huge community out there that are working on sustainability topics. And I mean, there's a lot of awards. There's, coaching, mentoring, all that stuff. But in the end, every startup, every company needs to somehow earn money because, you need to pay salaries. You need to pay for your infrastructure.
Yeah.
You need to pay for your investments. So, of course, the main thing that is important for startups and where they need support is actually winning the first clients, winning the first customers.
Yes.
So that's the kind of ask to corporates, also to investors. Include startups in your project. Ask them to support your organization in becoming more sustainable, and also make budgets available for that. So that also includes putting focus on digitalization inside of your organization. Don't be afraid of that. And otherwise, you will become the Kodaks of this world at some point, and nobody wants to be Kodak in the end. So
we have understood it.
Perfect. In the end, just the last sentence. One of the key challenges in actually working with corporates as a startup is also the procurement, because you agree on a nice project with a corporate, with the business unit. And then the procurement center comes from over there and starts negotiating about 90-day payment deadlines, and we want 10% off because we're paying all in one go.
And I know. I work in the procurement department. I'm the VP of procurement department. Well, all these challenges, we help startups to have more quick contractual relations with our company, and also to shorten the payment delay.
Yeah, build a good and fast procurement channel, especially tailored.
Yeah, it's very difficult in the big company. It's very difficult, but it's feasible.
Great.
Yeah, I mean, I think that's a challenge of dealing with large companies, but that they stay nimble enough to be attractive to promising startups. At BlackRock, we invest in startups as well, which are of a strategic nature, especially in the areas of financial technology, but also sustainability. We put a lot of money in a startup providing sustainability data, which is only 2 years old. I mean, it's a tremendous success story. That's kind of what we do on the corporate side. It has to be relevant and strategic for us. And then on the other hand, we put a lot of money to work, our clients' money to work in our in venture capital funds. And I was actually just wondering, are we an investor of Breeze, Robert?
I don't think
Is BlackRock an investor? No? Okay. No, because the other day I got this text message from a friend of mine who I went to business school with and said, wow, I just wanted to let you know, BlackRock invested. And I thought, my God, that's surprising. I would have never thought so. But we do invest in startups, and some of them seem,
We have our CVC as a small case, but we have our own vehicle.
But you know what, Mirjam and Alex, in 2019, September 25th, I still remember the date.
Precise.
In the evening, in New York, I asked Robert, do you need investment? And Robert, in a bar, Robert told me, I don't need money. I'm okay on my own. so no case for him, but I would say that will help a lot of other startups, reliable investors, not like hostile, very pushy investor is really important for startups, and more patient. Maybe since change, Robert, right? Maybe you was just drunk by then.
No. I think that was my true thoughts. I mean, we didn't raise outside funding. So I mean, in the beginning we tried. I told that story. Then everything changed, and now we get 2-3 investors reaching out to us per week, and I rather spend my time on working on projects and acquiring new customers than doing that.
Okay, great. Well, okay, thank you so much for a lovely discussion in the morning or in the early evening. Before we wrap up, I would highly recommend do the propaganda for our program. We're calling for application 2021. You just scan this QR code. It's specifically if you're a startup, it's free of charge, and it's a benefit. You can get a lot of benefits way beyond just money. You can also have a very lovely alumni network and get a opportunity to reach out a lot of amazing people like our panelists today. And so let's stay in touch. And thank you so much for Mirjam, for Alex, for Robert. Let's keep this discussion, this career continue. Thank you so much. Wish all of you have a lovely weekend. Thank you so much.
Thank you. Thank you.
Thank you.
Thank you.
Have a great day.
And you give us the title of the book again, okay?
Yes, absolutely.
Sure.
And next time I'll have it with me and I go.
Yeah. Okay. Right.
Okay.
Nice weekend. Nice weekend.
Thank you. Bye-bye.
Bye.